Lesson 2. Learning how the stock market works. A stock. A stock is a financial instrument that reflects a proportional claim on a company's assets, what it owns, and earnings, what it generates in profits. Stocks can be referred to as shares or a company's equity. Stock ownership denotes that the shareholder owns a portion of the company equal to the number of shares owed as a percentage of the total number of outstanding shares. For example, an individual or entity who holds 100,000 shares of a firm with 1 million outstanding shares has a 10% interest in it. Most companies have millions or billions of shares in circulation. Types of stock. While there are two types of stock, common and preferred, the term equities refers to common shares, since their aggregate market value and trading volume are many orders of magnitude more than preferred shares. The main difference between the two is that common shares typically have voting rights that allow the common shareholder to have a say in corporate meetings, such as the annual general meeting or AGM, where things like a board of director election or auditor appointments are voted on. But preferred shares do not. Preferred shares are so named because, in the case of a liquidation, preferred shareholders get dividends in assets before common shareholders. Common stock voting rights are further classified. While the basic idea of common stock is that it should have equal voting rights, one vote per share owned, some corporations have dual or multiple classes of stock, each with different voting rights. In a dual-class structure, Class A shares, for example, may have 10 votes per share. Dual or multiple class share arrangements are meant to provide the founders of the firm control over its finances, strategic direction, and ability to innovate. Why companies issue shares. Today's corporate behemoth was most likely founded as a modest private firm by a visionary entrepreneur a few decades ago, considered Jack Ma, who created Alibaba from his home in Hangzhou, China in 1999, or Mark Zuckerberg, who launched the original version of Facebook, now Meta, in 2004 from his Harvard University dorm room. Technology behemoths like these have ascended to the ranks of the world's most powerful businesses in a matter of decades. Growing at such a fast pace, however, needs access to a massive amount of capital. To turn a concept into a business, an entrepreneur needs, among other things, to lease an office or factory, hire employees, acquire equipment and raw materials, and build a sales and distribution network. These resources will cost a lot of money depending on the size and scope of the company at the start. Rising capital. A startup can obtain these funds by either selling shares, equity financing, or borrowing money, debt financing. Debt financing can be difficult for a startup because it may have a few assets to pledge as collateral for a loan, especially in sectors such as technology or biotechnology, where a firm may have few tangible assets. Plus, the interest on the loan would impose a financial burden in the early days, when the company may have no revenues or earnings. As a result, for the vast majority of firms in need of capital, equity financing is the preferred alternative. The entrepreneur may utilize personal funds, as well as funds from friends and family, to get the business off the ground. As the company grows and the need for financing grows, the entrepreneur may turn to angel investors and venture capital companies. Listing shares. When a business is created, it may require access to far larger quantities of money than can be earned through ongoing activity or a traditional bank loan. It can do so by selling shares to the general public in an initial public offering, or IPO. This converts the company's status from a private corporation whose shares are owned by a few shareholders to a publicly traded company whose shares will be held by a large number of members of the general public. The IPO also permits early investors in the company to cash out a portion of their stake, generally resulting in extraordinarily high returns. When a company's shares are listed on a stock market and trading begins, the price of these shares varies as investors and traders evaluate and reassess their inherent worth. The price-to-earnings, or PE ratio, is undoubtedly the most renowned of the ratios and indicators that may be used to analyze firms. Fundamental analysis and technical analysis are the two types of stock analysis. Stock exchange market. Stock exchanges are secondary marketplaces where existing shareholders can swap goods and services with potential purchasers. It is critical to recognize that firms listed on stock exchanges do not often purchase and sell their own shares. Companies may participate in stock buybacks or issue additional shares, although these are not day-to-day activities and frequently take place outside of an exchange's structure. So, when you buy a share of stock on the stock exchange, you are not purchasing it from the firm, but rather from another current shareholder. Similarly, when you sell your shares, you do not sell them back to the corporation, but rather to another investor.